Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute for November 17th, 2013. Stocks were up for a sixth week in a row last week. There were new highs in the S&P 500 and Dow Jones indices, and while there are always skeptics somewhere, the message over the weekend was clear. Stocks will keep going up. They have to keep going up. Yours is not to reason why. Yours is but to buy and buy. Could be quantitative easing. Maybe it's because it's the end of the year or performance chasing, but whatever it is, stocks are going to go up. And if by some lucky chance the market should retreat a couple of points, why, that's a chance for you to rush in and get in on the action. Well, that's not so good for equities. Whenever the market is absolutely sure of one thing, you can be fairly certain that something else is about to happen. Sometimes it's as simple as no buyers left, or it could be there are no sellers left, or it could be that someone notices that the emperor isn't wearing any clothes. So, is the market about to pull back? Well, it certainly entered into pullback territory, but that doesn't mean it has to, as 1999 proved. Sometimes prices go sideways for a bit, this is called backing and filling, and give buyers or prices or hyperbole a chance to take a breather. Then it gets even more overbought. Right now, the market is broadly divided into two camps. The Goldilocks camp, who is brought wholeheartedly into quantitative easing as a stock price guarantee, and they see all news as good news. And then there's the afraid to sell camp. They don't quite buy into all of the hype. They may even be a little bit nervous, but they are afraid to sell in case prices go higher. There's also a much smaller group of skeptics like me, but we're sort of off to the side. As the market moves higher, it does tend to drown out doubts and convince everyone that the economy really must be doing okay, otherwise the market wouldn't be going up like that, despite the experience of bubbles over the last dozen years. That's not really true about the economy. It's going sideways at a low rate of growth, lower than last year, but there is always next year. Every year since 2010, Wall Street has said that earnings growth will pick up next year, and every year it doesn't. Every year since then, the Fed has said that economic growth will pick up next year, and every year it doesn't. But the statements do provide a psychological boost until they don't. So I've been saying that the market was likely to have a November pullback, and now I'm going to say it should start this week. Maybe it will be the retail sales report on Wednesday, or maybe something in the Middle East, but traders will start looking for an excuse to take some profits. The size of the pullback will depend on the nature of the trigger. It could be anywhere from 1 or 2% to 5, 10% or more. Price levels make it vulnerable to 5 or 10%, but true believers could keep it to just 1 or 2. It depends on the news. I wish I could be more precise, but this is a sentiment-driven market. It's already quite overvalued, but people step forward every day to say that it isn't. So my advice would be not to commit any new funds, just wait and see. If you've got any holdings that have really taken off in the last month or two, don't be afraid to take some strategic profits. In fact, don't be afraid to take profits at all. Don't forget the old adage about reaping in times of prosperity. And don't be taken in by the noise of the herd. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.